Forex Fundamentals and Trading. Chapter 7. Economic Indicators. Section 1. Inflation Data. Inflation measures the change in the general price level over time. When prices rise broadly across the economy, each unit of money buys a little less than before, which means purchasing power falls. That matters to households directly, but it also matters to traders because inflation shapes expectations for interest rates, bond yields, and currency values. Very high inflation can squeeze consumers and businesses, while very low inflation can suggest weak demand or an economy lacking momentum. Most major central banks aim for something close to 2% inflation over time, because that is often viewed as consistent with stable growth. So when markets watch inflation data, they are really watching the pressure that prices put on both the economy and policy. The two most common inflation reports are CPI and PPI, and they look at prices from different points in the economy. CPI, or Consumer Price Index, tracks the prices households pay for goods and services such as food, rent, and transportation. PPI, or Producer Price Index, tracks prices received by producers and businesses, so it sits earlier in the chain. That is why traders often think of CPI as the consumer side measure and PPI as the business side measure. Sometimes rising producer costs eventually feed into consumer prices, which means PPI can hint at future CPI pressure. But that link is not automatic, because firms may absorb some costs rather than pass them along immediately. Inflation reports usually present both month-over-month and year-over-year numbers, and each one answers a different question. Month-over-month compares the latest month with the previous month, so it gives a sense of short-term momentum. Year-over-year compares the latest month with the same month a year earlier, so it smooths out some noise and shows the broader trend. A market might get concerned if monthly inflation starts heating up again, even while the yearly rate is still coming down. In the same way, a soft monthly reading does not automatically mean inflation is defeated if the yearly pace remains elevated. Traders get the best read when they use both measures together instead of leaning on only one. Headline inflation includes all categories in the index, while core inflation removes food and energy. Food and energy prices can swing sharply because of weather, geopolitics, or supply shocks, so headline inflation can sometimes move a lot for reasons that do not reflect broad underlying demand. Core inflation is watched closely because it often gives a cleaner read on whether price pressure is becoming persistent across the economy. If gasoline spikes for a month, headline inflation may jump even though the deeper trend has not changed much. On the other hand, if core inflation stays firm, markets may worry that inflation is more embedded and harder for central banks to bring down. That is why traders often react more strongly to a core surprise than to a temporary headline move. Inflation data is built from thousands of individual price observations collected across the economy. Statistical agencies track prices for many categories, including housing, food, clothing, transport, and medical care, and then assign weights based on how important each category is in household spending. Housing, for example, usually carries a much larger weight than something people buy only occasionally. Those current prices are then compared with earlier periods to calculate how much the overall index has changed. The result is an inflation index such as CPI, which can be compared month to month and year to year. Because the process is repeated regularly, markets get a monthly update on how price pressure is evolving. Markets respond less to the inflation number by itself and more to whether it beats or misses expectations. Before each release, economists publish forecasts, and that consensus becomes the benchmark the market prices around. If inflation comes in exactly as expected, the reaction may be limited because much of that outcome is already reflected in prices. If inflation is hotter than expected, traders may quickly raise their expectations for interest rates, which can push bond yields higher. A currency may strengthen at the same time if investors think that central bank will need to stay tighter for longer. In equity markets, growth-oriented sectors can come under pressure because higher rates reduce the present value of future earnings. Not all assets react to inflation surprises in the same way, because inflation affects each market through a different channel. Shorter-dated bond yields often move first because they are closely tied to expectations for central bank policy. If traders think rates may stay higher for longer, the currency can strengthen as capital flows toward that yield advantage. Growth stocks are often more sensitive because higher discount rates weigh more heavily on companies whose profits are expected further in the future. Defensive sectors may hold up better because their earnings tend to be steadier even when policy tightens. Commodity-linked sectors can sometimes benefit, especially if the inflation shock is tied to rising energy or raw material prices. This example shows why core inflation can dominate the market reaction even when the headline looks better. Suppose headline CPI falls from 3.4% to 3.1% year over year, which on the surface sounds encouraging. But if core CPI prints 3.9% when the market expected 3.7%, traders may conclude that underlying inflation is still sticky. In that case, yields can rise because investors push back expectations for rate cuts and price in a more restrictive policy path. The dollar may strengthen for the same reason, while equities, especially technology and other growth stocks, can sell off. The lesson is that markets are not rewarding the nicer-looking headline if the deeper inflation trend still looks stubborn. Inflation data is powerful, but it comes with several important limitations. One monthly report can be noisy, so it is risky to build a strong conclusion from a single print. Seasonal adjustment can also change the picture, especially in categories that move at predictable times of year. Temporary shocks, such as a jump in oil prices or a weather-related food spike, can distort headline inflation without saying much about the underlying trend. Some reports may later be revised, and producer inflation does not automatically pass through to consumers. Good interpretation means checking the trend, the composition, and the market expectation, rather than treating one release as a complete answer. A practical inflation read-through starts with a surprise. Compare the actual number with the market forecast first, because that often drives the immediate move. Then check headline and core together to see whether the pressure looks broad or temporary. After that, look at both month-over-month and year-over-year readings so you understand short-term momentum and the wider trend. From there, ask what the release likely means for yields, for the currency, and for risk assets such as equities. If producer prices are moving in the same direction, that can add another layer to the story, but it should be treated as a clue rather than a certainty. Section 2. GDP reports. GDP is one of the broadest measures of economic activity in a country. It captures the monetary value of final goods and services produced within national borders over a set period, usually a quarter or a year. The word final matters because GDP is designed to avoid double counting goods that are still part of the production process. When traders look at GDP, they are using it as a high-level gauge of whether the economy is expanding, stalling, or contracting. It does not tell the whole story by itself, but it provides an important overview of growth. In market terms, stronger GDP can support risk sentiment, while weaker GDP can raise concerns about slowing momentum. Nominal GDP uses current prices, while real GDP adjusts for inflation. That distinction matters because an economy can appear to be growing in nominal terms, even if actual production has not increased much at all. For example, if the same quantity of goods is produced but prices rise, nominal GDP goes up even though real output is unchanged. Real GDP removes that price effect, so it gives a better sense of whether the economy is truly producing more. This is why traders and economists usually focus more on real GDP when judging growth momentum. When real GDP is rising, the economy is expanding in a meaningful sense. When it is falling, that can be a warning sign of economic weakness. GDP moves markets because it changes perceptions about growth, policy, and future earnings. The key factor is usually the surprise relative to expectations, not just whether the economy grew. If GDP comes in stronger than forecast, stocks may react positively because investors see firmer demand and better business conditions. At the same time, bond yields may rise if stronger growth suggests the central bank will keep policy tighter. If GDP disappoints, markets may shift towards safer assets and lower yield expectations. In other words, the report matters because it feeds directly into how investors reprice the outlook for both the economy and interest rates. The headline GDP number matters, but the composition of growth often tells the deeper story. GDP is built from consumption, investment, government spending, and net exports, and each part says something different about economic strength. Strong consumption can suggest households are still spending confidently, which is often a supportive sign for growth. Strong business investment can indicate firms are expanding and feel optimistic about future demand. By contrast, a weak investment contribution may hint that businesses are becoming cautious, even if the headline number still looks solid. That is why serious analysis goes beyond the total and asks what is really driving growth underneath. GDP is not measured from one simple source. It is assembled from a wide range of information, including surveys, trade data, tax records, and business reports. And economists can estimate it through production, income, and expenditure approaches. Because much of the data arrives at different times, the first GDP estimate is only an informed early reading. Later releases, often called preliminary and final estimates, update the picture as more complete information comes in. That means the market may react strongly to an advanced GDP release, only to learn later that the true growth rate was somewhat different. For traders, the important lesson is that early GDP numbers are influential, but they are not final truth. Revisions are part of the process, so confidence should always be proportional. Quarterly GDP figures are adjusted to make comparisons more meaningful across the year. Seasonal adjustment removes recurring patterns, such as holiday spending or weather-related slowdowns, so one quarter can be compared more fairly with another. In the United States, quarterly GDP is also commonly reported at an annualized rate. That means the quarter's pace is expressed as if it continued for a full year, which can make the number look larger than the actual single quarter change. For example, a 0.6% quarter is roughly a 2.4% annualized pace. Traders need to keep that distinction clear, because annualized growth is a rate expression, not the literal increase that happened within the quarter itself. Imagine the market expected annualized real GDP growth of 1.8%, and the advance estimate comes in at 2.4%. That would be read as a positive surprise because the economy appears to have more momentum than analysts expected. Stocks might initially respond well, especially if investors think stronger growth supports revenues and earnings. Treasury yields could also rise if the report leads markets to expect less policy easing or even a tighter stance from the central bank. But the headline beat is only the first layer of interpretation. Traders would still want to know whether growth came from durable demand, such as consumption and investment, or from more temporary sources. A strong GDP number is not always as healthy as it first appears. If most of the growth comes from inventory buildup, that can be temporary and may even reverse in later quarters. By contrast, strong consumer spending usually suggests more durable demand, especially if it is paired with firm business investment. Investment matters because it can signal that companies are confident enough to spend on expansion rather than simply managing short-term conditions. Two GDP reports can show the same headline growth rate but tell very different stories about what comes next. That is why analysts study the components before deciding whether a positive surprise is truly encouraging. GDP is useful, but it has clear limits. It is a lagging indicator, which means it tells you what has already happened rather than giving a direct, real-time view of where the economy is going next. Advanced estimates can be revised, and revisions to earlier quarters can change the broader growth picture more than many beginners expect. It is also easy to over-focus on the headline and ignore whether the growth was real or nominal, broad-based or temporary. For practical market analysis, GDP works best when paired with timelier indicators such as surveys, employment data, and consumer confidence. The bigger point is that GDP gives context, not certainty. A disciplined GDP review starts with the real growth rate, because that is the inflation-adjusted measure of output. After identifying the headline number, look for the largest contributors to growth so you can judge the quality of the report. Then compare the release with market expectations to decide whether it was a beat, a miss, or broadly in line. Finally, ask what the composition suggests about next quarter momentum. If growth is broad and demand-driven, the outlook may be more durable. If the report depends on one temporary category, the market may fade the initial excitement. Section 3. Employment data. Employment data matters because the labor market sits at the center of growth, inflation, and consumer spending. Jobs determine household income, and household income supports demand across the economy. At the same time, wage growth can feed into inflation pressure, which makes employment reports especially important for central banks. A strong labor market can signal resilience, But if it runs too hot, it may also increase the chance of tighter policy. For traders, that means jobs data is rarely just about hiring alone. It influences expectations for interest rates, bonds, currencies, and equities all at once. The most closely watched U.S. labor release is the Employment Situation Summary, often simply called the Jobs Report. It is published by the Bureau of Labor Statistics and usually comes out on the first Friday of each month, which is why that day often carries extra market tension. The headline measure most traders focus on is non-farm payrolls, which shows the net change in jobs outside the farm sector. The report also includes the unemployment rate, which shows the share of the labor force that is unemployed and actively looking for work. Because it combines several major labor indicators in one release, it often creates sharp moves across Forex, bonds, and equities. In practice, traders prepare for it the way they would for any major event risk release. A jobs report should be read as a package, not as a single payroll headline. Average hourly earnings gives a sense of wage pressure, and that matters because faster wage growth can raise inflation concerns. The participation rate adds context by showing how many people are engaged in the labor force, which helps interpret whether a low unemployment rate really reflects strength. Revisions also matter because they can change the recent trend more than the latest headline suggests. A truly strong report often combines solid job creation, firm wages, and stable or lower unemployment without a troubling drop in participation. Looking at those pieces together gives a much cleaner picture of labor conditions. The monthly jobs report gets the most attention, but traders also watch several labor indicators between those releases. Initial jobless claims offers a timely weekly signal and can provide an early hint if layoffs are starting to rise. JOLTS, the Job Openings and Labor Turnover Survey, shows openings, hires, and quits, which helps traders judge how tight the labor market really is. A high quits rate can suggest workers feel confident enough to leave jobs and find new ones, which is usually a sign of strength. ADP rolls is another closely followed release because it offers a private estimate ahead of non-farm payrolls. It is useful as a preview, but it should never be treated as a perfect forecast of the official report. Employment data in the United States comes from 2 different surveys, and that explains why the report contains different types of labor information. The Establishment Survey samples businesses and government agencies, and it is the source of the payrolls number. The Household Survey samples households directly, and it is the source of the unemployment rate. This matters because payrolls count jobs, while the unemployment rate counts people. One person holding 2 jobs adds 2 positions to payrolls, but is still just one individual in the household survey. That is why the payrolls headline and unemployment rate can sometimes point in slightly different directions without either one being wrong. Employment data is noisy, so seasonal adjustment and revisions are essential for reading the trend more accurately. Raw payroll numbers can be distorted by predictable patterns such as holiday hiring, school schedules, or temporary weather effects. Seasonal adjustment tries to strip out those recurring influences so analysts can compare one month with another more fairly. Revisions are just as important because each new jobs report typically updates the prior 2 months of data. A headline that looks strong at first can become less impressive if earlier months are revised down. Experienced traders therefore focus on the trend across several months, rather than reacting only to the first print. Employment releases can move several markets at once, because they immediately affect interest rate expectations. If the data is stronger than expected, the US dollar often rises as traders price in a less dovish central bank path. Treasury yields may move higher for the same reason, and when yields rise, bond prices usually fall. Equities are more complicated because strong jobs data can be good for growth, but bad for valuations if it leads to higher rates. That is why stocks sometimes rise on a strong report and sometimes fall. The first reaction is usually fast, but the more durable move depends on how the market interprets the balance between growth and policy. A bullish job surprise usually means the key parts of the report all come in stronger than expected at the same time. If payrolls rise by 280,000 instead of the forecast 150,000, unemployment drops to 3.9% instead of holding at 41, and wages grow 4% rather than 0. 3. The market will likely read that as a tighter labor market. That kind of report tends to reduce expectations for near-term rate cuts, and can even raise concern that policy may need to stay restrictive longer. As a result, the dollar often strengthens and Treasury yields move higher. Stocks may react less consistently because better growth is positive, but higher yields can pressure equity valuations. The core message is that strong jobs, low unemployment, and firm wages reinforce each other. A big payroll beat does not automatically mean the whole report is bullish. The first thing to check is whether earlier months were revised down, because that can offset part of the apparent strength. It also helps to see whether hiring was broad across sectors or concentrated in only a few industries. Wage growth matters too, since a hot wage number can make the report more inflationary and increase rate fears. Participation adds another layer, because falling participation can make unemployment look lower without showing true labor market strength. So the headline surprise is only the start. The details tell you whether the signal is strong, mixed, or weaker than it first appears. A common mistake is reacting to the payroll headline while ignoring revisions to earlier months. Another is treating one weekly jobless claims number as a major trend signal when claims can be volatile from week to week. It is also easy to forget that wages and participation are part of the labor story, not side details. Sometimes payrolls rise while the unemployment rate also ticks up, and beginners assume that is contradictory when it may simply reflect more people entering the labor force. Good interpretation comes from putting the whole report in context. The best habit is to ask what the trend says, not just what the biggest number says. Section 4. PMI Indicators. PMI is a monthly survey-based measure of business conditions. It asks purchasing managers how things are changing across categories such as new orders, production, employment, inventories, and supplier deliveries. Because these managers are often close to the front line of demand, their responses can offer an early read on the economy before harder official data is released. PMI is published monthly, which also makes it more timely than reports such as GDP. Traders follow both manufacturing and services PMI because together they help capture broad economic momentum. In practice, PMI is valued less for precision and more for speed and direction. PMI is considered a leading indicator because purchasing managers often see shifts in business activity before those shifts show up in official statistics. If orders start slowing, managers may cut inventory, slow hiring, or reduce production almost immediately. Those business adjustments can happen well before slower moving reports such as GDP or employment fully reflect the change. The same is true on the upside when orders strengthen and firms respond quickly. That is why PMI can help traders spot turning points earlier than many traditional indicators. It does not predict perfectly, but it often gives an early signal that the economic trend is changing. PMI is reported on a scale from 0 to 100, with 50 as the dividing line between expansion and contraction. A reading above 50 means more firms reported improvement than deterioration. A reading below 50 means more firms reported weakening conditions. Exactly, 50 implies no net change overall. So a PMI of 58 suggests fairly strong expansion, while a PMI of 42 points to notable contraction. One important detail is that PMI shows direction and breadth, not exact GDP growth, so it should be read as a signal of momentum rather than a direct output measure. There are different PMI measures because different parts of the economy can move differently. Manufacturing PMI tracks factory activity. Services PMI tracks the much larger service sector in many modern economies, and composite PMI combines both into a broader view. In a services-led economy, services and composite PMI often matter more because services account for a larger share of output and employment. It is possible for manufacturing to weaken while services remain resilient, leaving the overall economy still expanding modestly. That is why traders should not rely on one PMI series in isolation. The most useful reading depends on the structure of the country you are analyzing. PMI data begins with a recurring monthly survey sent to a broad panel of firms. The panel usually includes companies of different sizes across manufacturing and services, so the responses reflect a wide business base. Purchasing managers are not asked for exact growth numbers. Instead, they report whether conditions improved, worsened, or stayed the same. The categories typically include new orders, output, jobs, supplier deliveries, and inventories. Because the survey captures direction rather than exact magnitude, PMI is fast to collect and publish. That speed is one of the reasons markets find it so useful. PMI is a diffusion index, which means it measures how widespread improvement or deterioration is across firms. The formula is simple: the percentage reporting improvement plus half of the percentage reporting no change. So if 40% report higher activity, 30% report no change, and 30% report lower activity, the index is 55. That score does not mean output rose by 55%. It means that improvement was more common than deterioration across the firms surveyed. This is why PMI is best understood as a breadth measure rather than a measure of size. The headline, PMI combines several subcomponents into one weighted index. New orders usually carry the largest weight, followed by output, employment, supplier delivery times, and inventories. That weighting matters because some components are more informative about current and near-term activity than others. New orders, for example, often give one of the clearest early signals about where production may head next. A 2 or 3 point move in the headline PMI can matter, especially if the subcomponents move in a consistent way. Traders therefore look at both the final headline and the pieces that are driving it. When traders read PMI, they focus on direction, persistence, and the mix beneath the headline. A rising PMI over several months can suggest firmer near-term GDP growth, while a weakening employment component may hint at softer labor demand ahead. Falling orders and output can point to weaker business activity and possibly weaker investment. If strength or weakness persists long enough, it can affect expectations for central bank policy. One report can be useful, but a trend across several months is usually much more informative. PMI is most valuable when it is treated as an early directional signal rather than a precise forecast. This example shows how PMI can send mixed messages about the economy. Manufacturing PMI falling to 49, 3 from 51. 2 suggests factory activity has slipped from expansion into mild contraction. If new orders are even weaker at 46, 8, that may point to further softness ahead in manufacturing. At the same time, a services PMI of 52, 1 shows the service sector is still expanding. A composite reading of 50, 9 therefore suggests the broader economy is still growing, but only modestly. The overall message is not recession yet, but rather a fragile expansion with one sector weakening and another still holding things up. There are several common mistakes when reading PMI. One is treating 50 as if it means normal growth, when it actually marks the border between expansion and contraction. Another is ignoring subcomponents such as new orders, which can sometimes tell a more important story than the headline itself. It is also a mistake to expect PMI to forecast GDP exactly, because PMI is directional and survey-based. Overreacting to a single monthly report can be costly when the more meaningful signal lies in the multi-month trend. And in services-heavy economies, focusing only on manufacturing PMI can leave you with an incomplete view of overall activity. A composite PMI uses sector weights to combine different parts of the economy into one broader reading. In this example, manufacturing carries a 20% weight and services carries an 80% weight, so the services sector has much more influence on the final number. That is why month 1 and month 2 stay comfortably above 50, even though manufacturing is not the only driver. By month 3, both sectors weaken enough that the weighted composite falls below 50, signaling contraction. The exercise shows why understanding sector weights matters, especially in economies dominated by services. A composite reading is not just an average of sectors. It reflects the relative size of those sectors in the economy. Section 5. Consumer Confidence. Consumer confidence measures how households feel about economic conditions now and in the near future. It captures sentiment rather than actual spending, but sentiment matters because attitudes often influence financial decisions. If consumers feel secure about jobs and income, they may be more willing to spend on travel, dining, appliances, or other discretionary items. If they feel uncertain, they may delay larger purchases and become more cautious. That is why confidence is treated as a forward-looking indicator of demand. It does not tell us what households already spent, but it can hint at how willing they may be to spend next. Markets pay attention to consumer confidence because household spending makes up a very large share of the U.S. economy. If confidence rises, consumers may feel more comfortable making discretionary purchases, which can support business activity and growth. If confidence falls, households may postpone bigger ticket spending, such as cars, home items, or vacations. That softer demand can ripple through the broader economy and weigh on company revenues. For traders, the value of confidence data is that it offers an early clue about spending behavior before all the hard data arrives. Since spending is such a large part of GDP, changes in confidence can matter more than the survey format might first suggest. In the United States, two consumer sentiment surveys are watched especially closely. The Consumer Confidence Index from the Conference Board is released monthly and surveys roughly 3 W00 households. The University of Michigan Sentiment Survey also comes out regularly, but with a smaller sample of around 500 consumers. Both aim to capture how households see current conditions and the outlook ahead, but they are not identical. The Michigan survey tends to emphasize personal finances and buying attitudes more directly. Because the sample sizes, question wording, and methodology differ, the two measures can move differently in the same month. Consumer confidence indexes are built by collecting survey responses, scoring them, and converting them into an index relative to a benchmark year. The questions usually cover current conditions and future expectations, and in the Conference Board measure, those parts are broken out explicitly. The final index is standardized, often with a base such as 1985 equal to 100, so current readings can be compared with historical norms. A reading above 100 means sentiment is above that benchmark period, while a reading below 100 means it is below it. But that does not automatically mean the economy is strong or weak in a simple sense. What often matters more is the direction of the index and the split between present conditions and expectations. Markets interpret confidence releases by comparing the new reading with both the prior month and the forecast. A small change may not matter much, but a meaningful surprise relative to expectations can affect sentiment across markets. It is also important to see which part of the survey move. If current conditions are steady but expectations weaken, that can signal caution about the months ahead even if the headline does not collapse. One noisy monthly print should not be overemphasized, especially if the broader trend is still intact. The most useful approach is to combine the latest number, the surprise, and the multi-month direction. Rising confidence may point to stronger household spending, while falling confidence can hint at softer demand. Sharp drops sometimes raise concerns that consumers are becoming defensive, which can feed recession worries if the weakness persists. But the message is never automatic. People can feel gloomy and still spend, or feel better while remaining financially constrained. That is why confidence works best as a directional clue rather than a precise forecast. Traders should always check it against harder data such as retail sales, jobs, income, and inflation. Suppose consumer confidence rises to 110 from 104 and beats the economist's forecast of 106. That is a positive surprise, and the headline suggests households are feeling better overall. If the present situation index rises strongly, that tells us consumers see current conditions as improved. But if expectations only rise to 92 and remain below 100, there is still a caution flag in the outlook. In other words, people may feel better about today than they do about the near future. Markets may welcome the stronger headline, but analysts will still pay close attention to the below 100 expectations reading. The sub-indexes matter because the headline can hide different stories underneath. A confidence index blends views about current conditions and future expectations, and those parts do not always move together. Strong present conditions can make the headline look solid even when households are becoming more worried about the months ahead. Expectations often matter more for the outlook because they are more closely linked to future spending behavior. Two identical headline readings can therefore carry different implications depending on what is driving them. Serious analysis looks through the top number to ask whether optimism is about today, tomorrow, or both. A drop in Michigan sentiment from 86.0 to 82.3 is a meaningful month-over-month decline of about 4.3%. If the reading also misses a forecast of 84.5, the market may treat that as a modest negative surprise. But the detail matters. If current conditions remain relatively firm at 92.0, then households may not be reporting major stress in the present moment. The weakness is likely showing up more in expectations, which suggests growing concern about the near future. That kind of split often points to caution in upcoming discretionary spending rather than a collapse in current activity.